Well, here we are, another Tuesday evening. How is everybody? And nice to see old names, new names on the show tonight. Just me, of course. So we'll get started in a moment. I'm going to put the pre-show on just for a moment as we tick up to 8 p.m. And as normal, of course, the dogs are here, having hopefully had their walk, and will be relatively quiet. The bins are being collected tomorrow, so it'll be hopefully relatively quiet today. And for those who've not seen the studio before, this is it. It's just me, but all the gear, of course, to make this work for various views, the multi-view, the chat, content that I'm going to work with, and a couple of other supporting screens as well. And I think everything's working, so hopefully no issues, but we never can tell. I noticed that the YouTube delay between my sending the stream and it actually appearing is a bit lower tonight, so I'm not sure why that is, but I haven't changed anything here. Maybe YouTube's changed something. But also be interested to know whether you've got any buffering. I know last week we had a couple of people buffering, but I checked back on the stream and it was actually definitely not me. It was actually must be the receiving end rather than the transmitting end, and everything's reported well here at the moment with an excellent stream health. Anyway, we've hit the 8 p.m. deadline. So I'm going to take the pre-show off. I'm going to start the show, but back in just a moment. Well, good evening and welcome to this live stream on the 13th of January 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you for taking some of your Tuesday evening out to share it with me. Really appreciate it. Going to have a really interesting conversation tonight about the latest data and also, of course, my modeling, with a focus specifically on households, how they're coping with the debt issues that many have, and also what's ahead. We'll touch on the new regulations that are coming in February for some mortgage lending. We'll also look at the latest data that's come out over the last few days relating to things like credit cards, debt, and a few other things too. So a lot to talk about, and we're going to get into detailed postcode analysis. I've got a few postcodes already that people have asked for, and towards the end of the show, we'll go into that. What we're going to do is we'll break it up into sort of three parts. The first part will be just the economic introduction. The second part will then be my overall analysis based on my modeling. And the third part will then be the detailed postcode deep dive, where we look at the detail down and show some of the maps and things like that. So that's the way to go. Just to remind you, as I always do, we're not providing specific financial or legal advice, a general conversation only. We moderate the chat, but feel free to throw your questions, comments in. And if you use @WalkTheWall DFA, that'll get into my queue. I've enabled Super Chat, which means if you want to get your question top of the list, you can do that. Or indeed make a contribution to around here. Greatly appreciated. All those who do help us via Super Chat, via Patreon, via PayPal, really just make a huge difference in terms of us enabling us to continue to make these shows. We don't do it for profit. We do this because we think it's a really, really important conversation to be had. So let's get the show underway. And to start with, just remind you, I've called this Haunted by Debt, Households Haunted by Debt, which postcodes are worse. And this actually builds from a bit of a conversation that we've been having over the last little while. I made a show earlier on called Households Crushed by Bills as Housing Costs Explode in 2026. And that was a quick summary of the stress analysis we did to the end of the year based on the modeling. And then over the weekend, I made another show called It's Rubber Hitting the Road Time for Many Households. And that was specifically looking at the debt data. Now, we've had some more debt information and also spending information today. Well, actually yesterday. And so this was the most interesting, the monthly household spending indicator data. And as Alex Joinder said from IFM, the household spending indicator looks solid in November, supported by Black Friday sales and major events, suggesting the aggregate household sector was continued to spend. Was contented, it should be, to spend. And also, he makes the point, this might add to the idea that the RBA will need to raise rates. So spending is strong, much stronger than people expected. People were talking about 0.1% or 0.4% or 0.5%, as I covered in my earlier show. Now, when you look at it in detail, it's worth highlighting that the services spending, and this is using the working age population data from IFM, was very, very strong. Goods was also higher, of course, as well. But you can see here that the services spending is, well, frankly, a combination of more spending, but also more costs, of course, because costs are rising, because wages are rising. And you can also see here that the non-discretionary was still growing faster than the discretionary. So people are spending more on the things that they absolutely need to have rather than the things that they would like to spend on. I think it's a really important observation. So a lot of households, not all households, but some households are in the situation where they really are, well, frankly, struggling a little bit. And in my earlier show, I tried to make the point there's a big distinction. In fact, there's a distinction between those who are really struggling, call them the have-nots, I guess, those who are doing pretty well, the haves, and are spending quite fast. And then there's the few percent at the top who are, well, they have, and they actually have a lot, and they're having a lot, and it's growing a lot. So it is really interesting to see how these different segments, these different cohorts are actually behaving. Now, of course, this aggregated data doesn't tease out this very important distinction between the haves and the have-nots and the super haves, as I call them. So it is important to try and understand that when you actually look at the data. What we can also say, though, if you look at this another way, this is actually from CanStar media release, credit card spending. So I highlighted the October credit card data in my earlier show. We got the November data, and it showed there that credit card spending was up, the transactions on debit cards was up, and in fact, everything was up. But they did make the point that the total debt on credit cards hit 19.7 billion. That's a big number. So we're seeing considerable growth in credit card debt. And all my analysis shows that this is very much not the case for everybody, but it is actually the case for some. So it is significant. Some people are doing very well. Others are putting more on credit cards. And CanStar goes on to make the point the average credit card interest rate is still well above 18%. Now, there are some cards offering lower percentage rates, 10% or below, and the law mandates that certain credit contracts, including continuous credit contracts, cannot exceed fees and charges that total over 48%. Banks are exempted from this. And it's worth noting that President Trump, of course, is proposing a 10% interest rate cap on US credit cards. But Australia already has caps on interest rates to a degree, but not really, right? It's just a very, very difficult situation. So as I highlighted the other day, there are some low rate cards, but it is important to do your homework. And look, the fact is that if you are on revolving credit, as many households are, I see that in my data, a lot of people with credit card bills, multiple credit cards, are those with significant financial pressures. Not surprising, really. Another interesting data point, just to continue the story, was the RBA reported that the cash withdrawals was still very strong. So all of this idea that cash is disappearing out of the system, not according to the ATM cash withdrawal data. So you can see it's been hovering pretty much the same all the way back to, well, 2020, really. It dipped, of course, through COVID, but it picked up again. So that is another factor to bear in mind when people talk about there's no need for cash. There is. Now, the ABS and the ABC showed some data recently showing that the annual income required to rent and not be in financial stress in Sydney is $135,000. It's lower in some other states. Perth, $121,000, Darwin, $124,000. But it is pretty issuey in terms of many people just cannot see that amount of income coming in. And we'll talk a bit later about the net and gross income footprints. But it is also worth highlighting what will unemployment do. So the RBA forecasts unemployment is expected to, well, maybe tick up a little. It's hovering around, 4-ish, 4.4, they say. If unemployment rates were to go higher, that would put a lot of pressure on people. If people are still in work, they may be able to continue to pay. And I guess my point is that everybody has been saying for a long time, yes, I'm in difficulty, but we'll hang on, we'll get through this because eventually our incomes will start growing faster. Inflation will come down, interest rates will get cut, and that will mean that I'll be able to muddle my way through and we won't have an issue. However, that plot is not working very well for many people. And as I'll show you shortly when I look at the detailed data, what we are seeing is quite a few people now really struggling with this question of, can I hang on long enough? Now, of course, remember the banks are extending and pretending by offering longer term loans. And bear in mind also, of course, that APRA's regulatory changes come in, particularly focusing on investors. They are putting caps on the high ratios now. That could put pressure on a lot of people when it comes to refinancing. And whilst the overall speed limit might be 200 kilometers per hour, for some people, this could be a real problem too. So that's another factor. But the critical question is interest rate trajectory, right? Because everyone was expecting interest rates to drop significantly from this point, but it's not necessarily going to play out like that. And here's the data that shows it. This is actually the latest from the interbank cash yield curve. And this shows you that they're looking now at 4 point something percent in June 2027. Now, of course, this is a market bet, but market bets here influence the forward rate for mortgages. And also it tells you what the markets are thinking about where the cash rate will be, which is higher, significantly higher. And in fact, another way of looking at that is this particular chart here. So this is actually the 2-year Treasury, and you're seeing it's hovering above 4.014%. So think of this as effectively a look into the future. And so they're thinking current 2-year rates above 4%. Now it's dropped back very slightly. It was up above 4.1% at the beginning of December, but you can see that it's rising, and the latest data doesn't seem to turn that around. So it does seem to me that we are in the situation where we're going to have this pressure on rates. Now, the reason this is so serious for many people is because the mortgages are growing bigger, the mortgages are growing longer, and so the impost on households in terms of their ability to service the mortgages is a big problem. And we'll see that, of course, in the data as we come to that. It's also worth highlighting again that productivity in Australia is pretty shot. And if you look at this chart here, the Australian labour productivity, this is from IFM, is 102 compared with 120 in the non-farm US labour productivity. And it's also worth highlighting, I think, that the spending for the national GDP compared with the spending at state and local, well, guess what? It's high, but you can see that the growth at national level is pretty strong. And the point I want to make is that this is a public issue, not just at the national level, but at the state and local level too. We've got too much debt in the system, and that translates to this sort of picture you can see here in this chart. If you look carefully, the Australian one here in the middle, rising very strongly, and we seem to be, chasing Norway and Sweden, which of course have always had very high GDP, share of nominal GDP on government consumption here. This is what we're looking at. Now, the other interesting point when you look at this data, that ANZ Indeed jobs data adds fell again in January, pointing to potentially ongoing easing in labour demand. And as Tarek posted, the possibility of a deteriorating labour market slamming the brakes on rate rises is much higher than the prevailing consensus suggests. The private sector isn't ready to carry this economy on its own. And that's really the point. The fact is that most of the momentum in the economy is government spending, but that government spending costs. It costs through higher taxes. It costs through potentially higher interest rates as well. And that's another factor in here. So we have an economy that's really not firing very well at the moment. And just to give you another angle on that, this was the latest entering external administration data. And you can see here that there's been a tick up again in construction. It's still top of the list there, as you can see, but other industries also up a little bit. And that's a real problem because, of course, it means that we do have continued pressure on the small business sector in particular. And in my surveys, I see quite a few small business owners who have mortgages getting caught up in this. So that's another factor in the mix of what's going on at the moment. Now, just to put the housing lens back on target here, this was quite good from Truth Hurts. Claire managing immigration, 1.2 migrants in 2 years. Claire managing housing, reformed nothing. House prices must always go up. Well, she did say that she wants to see prices rise sustainably, but actually, probably actually, truly, we're making housing more expensive at the moment. And on the approvals, the latest data did show that the approvals were up a little, but we're still well below the 240 target, 198,000. Grok reported the forecast suggests a total shortfall of 262. So, who knows? We're not building enough. We're not building the right types of property. As I discussed with Edwin yesterday, a lot of people want to live in houses rather than high-rise, but high-rise is where it's being served. And the latest intervention, of course, that I discussed the other day, shows that month-on-month changes in value for prices below the new price cap for the 5% deposit guarantee move stronger than above, which again suggests that the latest government intervention to do with first home buyers is not necessarily helping. It's actually pushing the story the wrong way. And we're going to see more of that, I think. So that's another bit of pressure on what's going on at the moment. So pressure on prices still there, not uniformly, as we'll see later. Significant pressure on employment, but significant pressure on interest rates. And so as I sort of come to the crunch point here, what does this mean for households? Because many households are really finding it difficult. Not everybody, but many. And just to sort of round that out, here is the latest consumer confidence indices. This is the Melbourne Institute Westpac, and it shows you that the consumer confidence is drifting further into pessimism territory, 192.9. That the family finances over the next 12 months is dropping, 97.8. And you won't see this in detail, but you can just see there that, a lot of the unemployment expectations are looking a little bit wobbly. Time to buy a major household item, wobbly. Time to buy a dwelling, down a little bit. And the broader economic conditions and expectations not flash either. So we have a situation where a lot of the economic indicators are pushing in one direction. The truth is that households are actually beginning to really question how this is going to shake out. And my data is suggesting that for many, it is now already a big deal. Now, of course, there's a broader international context here. We shouldn't forget, of course, the Trump saga in the US. And I made a show the other day, markets saw into 2026 as politics and power plays Trump's economics. And I think it's true. And of course, the latest chapter on that was the Federal Reserve, the Department of Justice launching a criminal investigation into Fed chair about the building work, and Powell making a video over the weekend saying the threat of criminal charges as a consequence of the Fed setting rates based on our best assessment of what will serve the public rather than following the preferences of the president. And I will make the point that I'm not a great supporter of the Fed, but the idea of not having an independent Fed and having one that's under the political gun, as it were, is a real problem. Markets are reacting, of course. And I will just make the point, the Department of Justice is talking about what were they building and why were they building. Well, what about this? Trump, what are you building? Why are you building it? I think that's a very important question. And I know that Trump has been on about the, affordability question. And so this question on credit card rates is a big deal. The 10% chances are that'll never happen, of course, because the economics of the credit card business means you need to be charging a lot more. And the cross-subsidization is huge, of course. And that's a big factor when you actually look at the economic situation of many people and the credit cards. Who is paying the interest? Well, it's the people who actually are effectively under the gun. But credit cards have always been like that. And there are alternative payment platforms around, of course. So that's the sort of the context, I guess, for this conversation today. And we can now move on and look at specifically the data. And to do that, let me remind you that we do the core market modeling from our surveys. We survey households on an ongoing basis, and that goes into the model. We can slice and dice the data, and we can look at it as well as today from scenarios, how it might play out. And when we do that, we can take the information from our mortgage stress data, from the trajectory of history of prices, from the buying and selling intentions, from migration, from the economic data, into the core market model, into the scenarios, and we can look at it at the postcode level, region, state, and all Australia level. And of course, I look at it down at the postcode level in this show because I think it gives you a better information base compared with a lot of others. And by the way, just to say that we're still providing one-to-one service. If you're interested in having a conversation with me about a particular postcode, we can do that and look at the underlying trends. This isn't financial advice, but we can look at the data. And if you want to book a conversation with me, it's an hour by Zoom or phone. You can do that. There is a cost involved because there's a lot of work involved to put this together for a particular area. But if you're interested, go to my blog. We're booking 3 to 5 weeks ahead at the moment. Now, just on stress, remind you again, I look at this in cash flow terms, money in, money out, not just 30% of income, whether it's taxable or not. Others use underwriting metrics, but I look at it on a cash flow basis, money in, money out. If households have more outgoings than income, they're stressed. If they've got a mortgage, they're in mortgage stress. If renting, they're rental stress. We look at it both in terms of investors, and we can look at total financial stress rolled up, of course, for all households in a postcode. And we can look at it in percentage terms and counts as well. I still think the law of big numbers shows us that the count is the most powerful way of looking at this. Which areas of the country have the biggest number of people in difficulty? Because that'll have a significant impact on house prices and broader economic activity in those locations, as well as maybe even things like crime and even local violence and those sorts of things in the area. Now, the RBA put this chart out some time ago, which I think is a lovely chart. It just makes the point that we go from budget pressures through missing payments to insolvency. At the mild end, which is where I'm measuring it, you're looking at money in, money out. Are people able to manage their budgets okay? But the risk is you drift into missing payments over maybe 3 to 5 years and then ultimately into insolvency. But of course, at the moment, the banks are trying to help by extending and pretending, moving people into interest only or longer term loans, refinancing, all of those things. And so the insolvency rates are still pretty low. But I must say that what I'm seeing in my data is that we've still got a lot of households in Australia with budget pressures. And now the question of missing payments is beginning to focus into view. And just to show you how that works, this is the latest data from our stress analysis to December 2025. And you can see there that the rental stress is at 74.7%. That's nearly 3/4 of people in the rental sector with cash flow pressures. The mortgage stress is at 50.2%, just over half of households with a mortgage. And the debt to income ratio has come down, but the RBA keeps restating this. And remember that it's all households, whether you've got a mortgage or not, so it's a bit artificial. The typical ratio is 5, 6, 7, 8, 9 times for new mortgages. Now, this is the data for November. And I went through this in more detail the other day, but just to highlight that we have basically in November, we had that amount, 49.5. It's gone up to 50.2% of mortgage stress in December. And you can see there that that translates to 1.88 million households with a mortgage problem. The rental stress at 74.7% is 2.32 million households with problems. There are still some investors, just over 500,000 investors with investor stress. And overall financial stress at 47.4%, that's 4.7 million of the pretty much 10 million households in Australia. So that's a big number. And comparing it with last month, 47.2 last month, 47.4 this month. So the percentage rose slightly. Now, if we look at it in terms of the segments, you can see there that by cohort, young growing families are standing out there at 79.6% in the rental stress, but 90% in the mortgage stress sector. The multicultural establishment, that's the first generation Australians, 80% of first generation migrants, 80.9% actually, have an issue. And so people are moving into the country and getting into difficulty quite quickly. And overall, you can see there that if you look at the average financial stress, well, young growing families are very much there, but other cohorts are impacted too. So it's not just a young person's problem. Some of the older household groups are also up against it too. Some of the more affluent groups too. So it's quite widely spread. This is the data And it just makes the point that there are postcodes where we've got a lot of pressure. Liverpool 2170 is top of the list with more than 13,000 households with difficulty. Then Campbelltown in New South Wales, then Toowoomba, then Roxburgh Park in Victoria, Wanneroo in Western Australia, Tarnit in Victoria, Narre Warren in Victoria, Ballarat, of course, regional area as well, Berwick and Harkaway in Victoria, Riverstone in New South Wales, Pakenham in Victoria, Success in Western Australia, Merriwear in Western Australia, Cranbourne. Now, a lot of these are high growth corridors, a lot of new properties being built, lots of first time buyers, a lot of first generation migrants all buying in those areas. All of those things are there. If we look at the rentals, if we look at the risk of default, Cranbourne, Mandurah, Roxburgh Park at the top of the list. This is the count of risk of default over the next 12 months. And it's worth just highlighting Mandurah because this is one I've been watching for some time. Remember that there were problems in the middle of the last decade in the West. Prices dropped, people got into difficulty, prices have started to rise, but that earlier problem is still there. So this is a hanging about for quite a long time problem. It doesn't go away when prices start to rise again. And that's the thing to bear in mind. So households in some of these areas are going to find it quite difficult. And also highlight that places like Gosford on the Central Coast, for example, or Toowoomba up in Queensland, these are all areas where defaults are likely to rise ahead. In the rental stress sector, Melbourne, 3,000, top of the list, then Toowoomba, then Liverpool, Southport in Queensland, Campbelltown in New South Wales, Tarns in Victoria, Derrimut in Victoria, Mount Druitt in New South Wales. We'll come on to that in more detail. Somebody asked for Mount Druitt details, so we'll look at that shortly. Ipswich, of course, there as well, Parramatta, so you can see it there. And the stressed investors, well, it's interesting. Westmead, Bundaberg, Wembley, Toowoomba, Narrabeen, all areas where some investors are struggling. Why? Because it's difficult to put rents up if you've got people who are actually unable to pay the rents. Toowoomba, rental stress. Toowoomba, investor stress. It's the yin and the yang of the same problem. And then finally, financial stress. If you look at the financial stress, the Toowoomba story is top of the list this time. So that's where the aggregate stress levels is highest. Then Liverpool in New South Wales, 2170. Then Campbelltown, 2560. Then Tarnit, Roxburgh Park in Victoria, Ipswich in Queensland, Derrimut in Victoria, Mount Druitt in New South Wales, Melbourne, postcode 3000, Cranbourne, Ballarat, Southport, Belwood Park, Westmead and Bundaberg. And I could go down another list, but you can see there that the percentages are relatively high in some area. And so these are big problems for a lot of people. Now, that gives you a bit of baseline then, and then we can look at it in a bit more detail. If we do that, the way to do it, I think, is to think about some of my mapping. Now, I can map all sorts of different ways. I can map mortgage stress, I can map rental stress, I can map financial stress, default rates, gross investment returns, net investment returns, net wealth footprint, and gross debt footprint. Now, I have not shown you the net wealth and gross debt footprint until now, but I'm going to do that today. To do that, let me just switch across to this chart. Just stand by while I get myself sorted out here. We need to go to mapping, transition. Right. So let's start. So this is the mortgage stress count, just to start with, to get the mapping going. And you can see there that we've got in blue the lower counts of stress. And as we go up through the yellows into the oranges and reds, we've got the greater levels of stress. As we pull out, you can see here that in and around the centre of Sydney, not too much issue. Slightly bigger number, even in some of the more affluent areas like Mossman and Vaucluse. There are some people in difficulty. Waterloo, Parramatta, Ryde, Lane Cove. As we pull out, of course, we start to see the big problem childs coming up. Liverpool is a hot spot, as I showed you in the earlier data there. No surprise. And that continues to be the same problem insofar that we've got people who are struggling. And as we pull out further, you can see Campbelltown is on the list, and 2765 as well. So you've got this problem. The West is where a lot of the mortgage stress resides, in and around Sydney, but there are pockets closer in. Now, if we go to the next area, let's go to Melbourne and do the same. And we can see the similar sort of story with the problem issues beginning to bubble up around the centre of Melbourne, not in the centre of Melbourne, but as you go out Moonee Valley, there's a few areas there we move into the yellows, but then 3029 in the Wyndham area, Point Cook and Court, places like that. And as you pull out further, you can see that there are significant pressure points in and around the place. And so you've got these hot spots to the north, to the east, and to the west in and around Melbourne. And if we pull out slightly further, you can see even Ballarat's there as well in the regional areas. So that's consistent with what we've seen. We'll just do one more. Let's go across to 6,000 and look at Perth. And Perth, of course, is one to watch because there are significant price pressures in Perth, which means that people are having to actually get bigger mortgages to be able to buy. And as we pull out away from the centre of gravity of the 6,000 postcode and look to the north and to the south, you can see that there are significant pressures. 6065 is one which really stands out as a problem area, but also areas to the south and to the north, and a lot of the areas up and down on the coastal strip, which is some of the new development, is where a lot of the difficulties are. Now, we will just quickly look at an alternative story. Let's look at rental stress, just to show you the different story here. So rental stress, looking at postcode 2000, you can see there in and around the centre of the place, you've got some significant. Waterloo's a bit of a hot spot, Randwick, Bondi, Wollstonecraft, Narrabeen up there as well. And then as you pull out, again, you can see that there are pressures over to the west too. But I would highlight that we've got quite a few pockets in and around Sydney where mortgage stress is high, but rental stress is even higher. And as we go out west, you can see there that pretty much those same areas, Campbelltown, Liverpool, around Parramatta, Bankstown, places like that. If I look at Brisbane, I want to highlight the fact that we've got more rental stress now in Brisbane than we've ever had. This is deteriorating quite quickly. And you can see South Brisbane and Bowen Hills, for example, is looking pretty concerning at the moment. And as we pull out, you can see there that there are considerable pressure points. Not universally. Ipswich, of course, is on the list as well, as I highlighted earlier on. And whilst the population density is a little bit lower than in Sydney, you can see that down on the Gold Coast there are issues too. There are even some red areas. 4209 is one that stands out there. And then 4350, which of course is the old Toowoomba story. So that's the story in Brisbane. And, we could look at another one. We just will look here at Adelaide. Rental stress in Adelaide is not quite as bad as Brisbane, but with the prices rising in Adelaide so fast, a lot of international and interstate investors have bought into Adelaide and they're putting the rents up quite a lot. So we have a number of people now, I remember the population density is lower, where we're in the yellows. So that's a bit of an issue. And we are seeing significant pressure, but the counts are not as big here because the population density is somewhat lower. So that gives you a bit of rental stress information and mortgage stress information. But now I want to show you the next angle. I think it's worth interest in looking at net wealth. So net wealth is defined as the amount of wealth that a household has, including property, other assets, investments, and also superannuation, less outstanding debt. And you can see here that below 236k is blue. I've started in Adelaide, and you can see there that there are some people in and around Adelaide who really, well, don't have a huge amount. I'm just going to clear my throat. Excuse me 1 second. Sorry about that. Yeah, so Adelaide, you can see there that there are areas with some assets, but the net wealth is sitting, well, 1.1 to 1.7 mil. It's quite a lot in the yellow there. Not a lot above that in and around Adelaide. Now, if you compare that with Sydney, it's really quite interesting because you can see there immediately places like Darling Point and Vaucluse, people are right up the top of the scale there. A lot of net wealth. It's quite good in Mossman, as you'd expect, with Hunters Hill, Haberfield. And as we go out towards the west, Waterloo is a bit of a problem with not huge amounts of assets there. Remember, I'm looking at everybody here, including those who are in the rental sector as well. This is everybody. Liverpool, of course, stands out as a lot less real net wealth. Hornsby's quite good in comparison. As we pull out, you can see here that actually as you go west, not only is the mortgage stress higher, the rental stress higher, but the net wealth is quite a lot lower too. So you can see how the pincer movement is working there. And if we look at Melbourne, bit of the same issue in and around the city. Carlton's quite limited in terms of net wealth. And by the way, below means that some could be zero or negative. It's just a matter of averaging. But you can see as we go out, Turac's looking somewhat better. Glen Iris is looking better. But there are areas, as we pull out again, that shows significant limited net wealth sitting out there at the moment. And there's a bit of correlation between some of the stress and some of the issues that we're looking at more broadly. Frankston is an interesting one, I find, and down towards Geelong, for example, as well. Now, we could look at Brisbane. Interesting, similar pattern, a bit more wealth sitting there. But there are areas like Wollongabba and Dutton Park 4102, where there's not a lot going on, and also to the north 4030 and 4031 at Kendron, for example. And as we pull out, you can see again the same story, that there are areas around Ipswich Way where people has very little net wealth. Remember, I'm including here all the superannuation, the pensions as well. So I'm looking at the total aggregate footprint of households here. And we might just look at the west over in Perth. And in Perth, of course, there are areas like Wembley, which is not doing too badly. Netherlands, of course, Mount Clermont, City Beach, Swanbourne, places like that. Mossman Park. And as you go up the coast, you can see that there are some areas where things are not looking too bad, but you can also see there are areas where the net wealth is somewhat low. But here, because of the strong house price growth recently, actually the net wealth is a little stronger than we've seen previously, simply because of the fact that prices are actually growing quite fast. So that gives you the net wealth story. And then the other one I want to show you is the debt footprint. Now, this is really interesting. So here what I've done is I've looked at households, only households who are borrowing. And if they're borrowing in some way, I've looked at the average amount of debt that they've got. So I'm only looking at households with debt, not all households. And I've got it here, again, coded with the blues down below and the reds and oranges high. And if you're in the red sector, you've got 3 million or more in debt. And as we pull out, you can see that the average amount outstanding is actually quite high. You know, Mossman is at the 1.4 to 3 million. My doorbell just gone. Let's see whether the dogs decide to bark or not. You can see here, that's the postman, that North Ryde was and Mossman quite high. And you can see that the debt footprint compared with the over in the west. So it's fascinating that the debt footprint in absolute amount borrowing is a lot lower out in the west. But these are the very areas where we've got a lot of financial stress issues. Whereas here, the debt is still very high, relatively speaking, but nevertheless, people are actually managing. Now, of course, that's to do with relative incomes. It also shows that the banks are actually willing to lend and lend big in certain areas, much more than others. And there are some postcodes where things are somewhat now blacklisted in terms of their willingness to lend big. If we look at Melbourne, in the centre of Melbourne, we do have significant debts there. As we pull out, you can see that there are also significant issues. Now, those debts include mortgages, it includes credit card debt, it includes buy now, pay later, it includes all the different, consumer debt of all the different types as well. So it's all aggregated here. And you can see that there are areas like Bayside where there's quite high levels of debt too. The amount of debt outstanding, though, if you look out there in places like Wyndham, we're talking here well over 1 million for many people in those areas. And of course, it's an average. There are some high ones and some low ones. And you can see there that out towards 3810, for example, there's a really big hotspot there, and in the Dandenongs too. And if we look across to the west, we go to postcode 6000, you can see again that we've got quite a lot of areas where there's a lot of debt. And the amount of debt's growing quite fast. Again, big mortgages, but also other types of debt too. And as we pull out, you can see that, in fact, the debt footprint is actually quite considerable in and around Perth. If you go up to the coast and down from Perth, down the coast, you've still got significant amounts of standing. And 6030 at the top there is actually showing a very significant exposure. So I think that's very interesting. Remember, those are averages, but it shows you that, again, the debt, stress, and net wealth are all sort of interestingly interlinked. And it's only when you start to see it all put together do you actually see how it all works. So we'll just go to Brisbane to finalise this little story. And here's the story. A lot of debt in Brisbane. Fortitude Valley, South Brisbane, Hurston. Big amounts of debt here. And remember, we're talking debt that is 5, 6, 7, 8 times income quite often. So it does show you that people are actually really in hock. Now, compare that with further out, Ipswich, for example. In Ipswich, the actual amount of debt is actually somewhat lower. Now, that's because there are more people there, of course, with lower debts, or they're in the rental sector and only have credit card debts and those sorts of things. So it's not completely universally accurate, but it gives you some indications of where the problems are and where they're not. So I thought that was quite interesting. And in fact, there's an article coming out shortly. I've shared some of this information with one of the newspapers, and you should see some of this information being shared and talking about some of the issues underlying it. So that's that sort of part of the conversation. Now, the next part of the conversation I want to get to is very much looking at the detail, and we'll look at our postcode modeling and all of that stuff now. I'm just on the way and remind you that, of course, when I think about my analytics here, and particularly my scenarios, I use scenarios not as a predictor of what may happen, but as a sensitivity analysis. I think it's really important to understand that. So scenarios are ways of exploring different futures. And none of them will probably be right, but it shows you how the sensitivities work. And so I have 3 scenarios. And the first scenario is the Goldilocks zone. So you see rates at 3.6% until the middle of 2026, but they then get eased. Inflation stays above target until later in 26, but then comes down. Migration remains above average. We get the boom from first-time buyer purchases, but we don't get a recession. The base case is a softer landing where rates are on hold at 3.6%. Inflation eases later in 2027. We do see wages rising faster than inflation, but we do get a recession in Australia and migration falls to average. And the nightmare landing is where rates rise from 3.6% and inflation steps up. Unemployment rises, wages growth stalls. We do get some rate cuts later, but migration drops away below average and we get stagflation. Now, those are the 3 scenarios. I usually could put a lot of other scenarios in, but it gives you a bit of a flavour. And if we do that, it's worth just looking at the average across Australia here. So on the best case, houses across Australia on average could be 10% higher in 3 years on the best case scenario. On the base case scenario, they could drop a little, maybe 4 or 5% over 3 years. The worst case is a fall of 25%, worst case over 3 years. And units would follow on pretty closely. Now, we can also look at this looking at specific areas. The ACT is an interesting one. ACT is not showing a huge amount of growth, even in the best case scenario, up 3% over 3 years. The base case, a fall of 12% and a fall of 32% over 3 years, and units following along somewhat similarly. Units tend to fall a little less because there's a bit more demand. If we look at New South Wales, 8.4% best case, down 7.2% base case, down 27% worst case, and units again following on. And if we go to the NT, which has been very strong, another 20% is possible because of demand there. But the base case is 4% over 3 years, and the worst case down 16%, units again following on. And if we look at the Queensland story, again strong, 14% over 3 years, base case down 1.4%, and the worst case down 21%. And if we look at those in terms of units, following along pretty well. South Australia, very strong, 17%, 1.4%, and down 19% on the 3 scenarios. And units following on. And then Tasmania, hardly any growth, 2%, best case scenario, down 13%, base case scenario, down 33%, worst case scenario, and units following on. And in Victoria, best case 7.6%, base case down 8%, worst case down 28%. Victoria worries me. I still see a lot of negativity there. And again, units following on. And finally, Western Australia, up 14%, base case flat, worst case down 21% over the next little while. Now, of course, we can look at this at a detailed postcode level, and here is the data for the particular way we do it. This is from the model, and you'll be aware of this. We've used it quite a few times before, but it shows us things like the household mix, shows you the stress data, it shows you the combination of scenarios ahead, and also things like gross and net investment yield. So that's what we're going to turn to now. And it is, I think, fascinating to look at this at the moment, simply because the data that I'm seeing is beginning to work its way through, and some of the things that I was suggesting is going to happen is beginning to happen, which is why I say I think a lot of households are under significant pressure. So to do that, we need to actually load our model firstly. And to do that, I need to switch that into stress analysis and transition and put that up there. And if I do that, you can now see. Okay, so this is now the live model. And you can see here that in Wollongong, which is a good place to start, you can see here we've got pretty much 20,000 households, but 48% are renting, 23% are borrowing, and 28% owning outright. But we've got a lot of mortgage stress, quite a lot of rental stress, and overall financial stress is 56%. You've got, 35% houses, more units. The centre of Wollongong is turning into a nightmare for units, frankly. And you can see here we've got quite high vacancy rates. The gross investment yield's positive at 3.4, net investment yield minus 1.5%. So they're losing money on average for investment properties in this area. Taxable income on average from the ATO is 89,000, 84,000 from the census. Disposal monthly income is around $6,000 a month on average. That's after tax, of course. 41% going on the mortgage, 2,467. 33% going on the typical rent, 1,993. And looking at the scenarios, you can see here, best case, small rises ahead, base case a fall, worst case a more significant fall, and units following on. So that gives you a bit of a flavour of what we can do. So I did suggest that people might want to put in postcodes before we started. And in fact, we did get Sally, for example, who said, watch your shows with great interest and appreciation. Would be helpful if you could look at postcode 2576, your upcoming show. Yep, now that's a Baradu 2576, which I've not heard of before. It's an interesting little area. And the first thing I did was to look at the information on price movements. Now, this actually shows you the percentage moves from December 2026 to December 2016 to 26. And you can see here that there were massive hikes in 2020 and 2021, small rise in 22, a fall in 23, and, small rises the last 2 years. And that translates to the median house price back in November 2016 was 1.249 million. Now it's 2.153 million. But I want to highlight prices really since 2021 have eased sideways and gone down. And I think that's quite an interesting little observation. Now, if we put 2576 into our model, which I will now do, and cut back to the other analysis, you can see here that 2576 on the south coast, 6,000 households, 55% own outright, but 27% are borrowing and 70% are renting. There's a fair amount of mortgage stress, 44%, a lot of rental stress, 93%. And you can see here that 83% of houses, which I focus on the houses in that data point I gave you, of course. And you can see that the people ratio is just above 2. So, maybe elderly couples as well as families. You can see there that the vacancy rate is quite high. So some second homes, Airbnb, those sorts of things. Gross investment yield is 3.1%, but the net investment yield is minus 2% here. The average taxable from the ATO was reported 152,000, but the census gave us 87,000. Now, whether that was to do when the census was taken, but the ATO data is the more recent of the two. But on average, you see a disposable monthly income just over $5,000 up to about $6,000. So you've got very high, 48.5% of that going on the mortgage, 2,844, and 42%, 2,467 going on the typical rent. And scenarios, I don't see much growth here, even in the best case scenario ahead. And the base case may be a bit of a fall, and the worst case, a more significant fall. So that's the story there on that particular postcode. Now let's look at the next one. So let's go back to here. So Richard asked for postcode 2770. That's Mount Druitt. And looking at the trends in Mount Druitt, it's quite interesting. So the first thing we'll look at is the price moves. And it's very interesting. You can see that actually, other than 2018 and 2022, we've seen significant price moves in the last 10 years, from December 2016 to December 2025. And of course, there were very significant off to the race moves post-COVID, but there have been strong moves since. And when you look at the average median price, $606,000 in December 2016, now over $1 million, 1,086. Now, this is one of the more affordable areas, of course. And going back to what I said earlier on about the fact that prices were growing more strongly in areas where they still fell within the new 5% deposit scheme, it's one of the reasons why we're seeing quite a lot of growth here. But, is Mount Druitt one of those areas that is really flash? No, not really. It's growing though. And so people are actually moving out into these areas because of it's a little more affordable than closer in. Now, if we look at my data set, so 2770, let's put that number in and I'll switch across to it. Okay, so let's go to Mount Druitt. Whoops. What's happened here? I moved my mouse. There you go. So 20,000 households in this postcode. 20% own outright. 29% are borrowing, but 50% are renting. So this is rental city, of course. A lot of people in mortgage stress, a lot of people in rental stress. Financial stress is very high, 84% here. And that's putting significant pressure on scenarios ahead. So I'm struggling here with those price rises and the massive amounts of financial pressure that I'm seeing. How do we rationalize it? Well, it's difficult to, but I don't believe that we're going to see much in the way of growth in this area because of this significant financial pressure there. Houses, 76%, units 10%, vacancy rates 6.7%. People ratio is quite high, so a lot of families here in these areas. Gross investment yield, positive 3.3%. But again, net investment yield, this is, of course, net investment yield means the difference between the rent you can charge and the payments you have to make to manage and own the investment property. It's minus 0.9%. Average taxable 70,000, 68,000 from the census. That's pretty consistent. That gives a disposal monthly around $5,000. 43.9% go on typical mortgage, more than $2,000, and 23.4%, $1,595 going on the typical rent. And as I say, the scenarios don't look that flash here at the moment. But, how do you square the circle? Well, I suppose if enough people continue to flood the area because it's cheap and because of the fact that the government is encouraging people to take those 5% deposits and get into debt, well, it could be an issue. If, on the other hand, we're looking at mortgages at higher debt and LVR ratios, then maybe under the new regulations from APRA, that'll put a brake on it. We'll see. Now, let's look at the next one on my list. Cut back to that. So, Aussie bloke asked for Castlemaine 3450. And again, I managed to look at the price moves in Castlemaine. Quite interesting. Very interesting, very strong in 2021. Bit of a fall in 2022. Bit of a fall in 2025. But there was a little move up in 23 and 24. But you can see there that 17 and 18 was a lot stronger than more recently. And if you look at the price moves, well, in 2016, it was 297,000 for a typical house in this area. It's moved up to 517,000. But you can see here that, draw the line from 2021, it's up and down a bit, but it's not really moving up significantly. And I think that's very important to understand. Now, if we look at my data, 3450, go back to the other one, 3450. Okay. So here, 3,400 households. Half own outright, 26% of borrowing, 23% of renting. We've got mortgage stress at 79%, rental stress at 66%, overall financial stress at 38%. Mostly houses. People ratio is somewhat lower than we've seen before. Could be some single people possibly there. 9.7% vacant, 3.5% gross investment yield. Again, net investment is negative, minus 1.6%. I want to highlight again how many investors are under the water at the moment. Taxable income from the ATO, 81,000. The household census said 57,000. That translates to a disposal monthly of around $4,000, with 40% going on the typical mortgage at 1,634, and 36%, 1,495, going on the typical rent. And scenarios, I can't see much growth ahead. And best case scenario, down 2% over 3 years. The base case, a more significant fall ahead. Now, the next one here, Robin asked for Horsham, 3400. And Horsham's quite an interesting case as well. So let's look first at the price moves. 2021 was a massive hike, more than 30% up. And in fact, 2025 was also quite strong, about 13%, 14%. There were falls in 2013, 2017. And rises in other areas too. So what's going on? Well, in December 2016, $239,000 was the typical price. Now it's $439,000. And I want to highlight again, this trajectory upwards is at the lower, more affordable end of the spectrum. And I think there's a reason why that is the case, because there is still more demand for cheaper relative housing. So $439,000 in 2025. Now, if we look then at the postcode data for this particular postcode, 3400, let's put it in. Okay, postcode 3400, cut back, you can see it there. 6,800 households, 37% earning outright, a third of borrowing, 30% of renting. Again, relatively high levels of mortgage stress, 65% compared with 54% for rental stress. 88% houses, and people ratio is just above 2. The vacancy rate, 8.7%. Remember, the vacancy rate was done at the time of the census, which was, of course, just around COVID, so it might be a bit off. The gross investment yield, 2.9. Net investment yield, minus 1.3%. Average taxable, $78,000. Household census 67,000, giving a disposable month around $4,800, with 29.2% going on the mortgage, 1,424, 25%, 1,221 going on the typical rent. And so that is a little bit more affordable, And that's perhaps one of the reasons why the prices were a little higher. And in fact, we're still seeing in the best case scenario, small amounts of growth ahead, although in the base case or worst case scenario, that might well come off because of the more significant pressure on households. And once again, we'll look at another couple of queries that we got beforehand. This one from Kent 3W, Newington. Let's put this back up so you can see it. So Kent 3W, Newington, postcode 2127. And here, if we look at that particular trend, well, massive spike in 2021, a significant spike in 2023, and 2024, not so much in 2025. And there was a fall in 2018 and 2022. Looking at the trajectory, 1.23 million in 2016 and 1.89 million in December 2025. So you can see there, and you can see there that there was a bit of a fall and then it's a further rise up. And if we look at that, if we look at Newington 2127 in our model, okay, so in the model here, you can see 10,800 households, 55% are renting, a third are borrowing, and 10% are owning outright. 48% in mortgage stress, 78% in rental stress. Overall financial stress is pretty high. The units are much, much higher than the houses. I did show you houses, but hey, it's units that probably is where the focus should be. And you can see there that the gross investment yield was 3.4. Net investment yield again is negative, minus 1.3. And taxable on average, 96,000, 108,000. The multi-flag comes up suggesting that the household is effectively getting multiple income support from people there. So families are putting more than one income in to get the mortgage. Average disposable around 7,000, with 38.8% going on the typical mortgage and 35% going on the typical rent, $2,160 a month for the mortgage and $2,552 going on the typical rent payment. Ahead, I'm struggling again to see much in the way of momentum here, simply because of these higher levels of stress that we're seeing. So this is the more expensive property area, of course, as I showed earlier on, and demand is perhaps a little weaker, particularly above the 5% first-time buyer support program. Right, let's go back. I think this is the last pre-filled one from Kerry. So Kerry Mills said, could you do Tasmanian state cities like Hobart, Launceston, and Devonport? Yes, of course I can. And this is really interesting when you look at these. So let's look firstly at the movements in price. Hobart, significant upward momentum in 2017, 21 and 22, not a lot since. And prices in 2016, typical houses, 614,000, compared with just over the million now. And you can see here the trajectory down from a peak that was a lot higher in 2021. And this is the story of Hobart, of course. It is continuing to find it quite difficult here with prices beginning to slide and continuing to slide. If we look at Launceston, you can see here that in 2021, big peak in 2024 as well, much smaller peak there. But in 2022 and 2025, a bit of a fall. Prices, 387,000 back in 2016, 764,000 in 2025, and a little bit of a down from 2021, and then a small rise up. And Devonport, interesting story here. A lot of rises, almost no falls. And 2021 was strong. 2025 up 15%. Very interesting, different from Hobart. And you can see there that prices went from 217,000 in 2016 to 542,000 December 2025. So cheaper property, people buying cheaper property and putting prices up higher. So that's very much the story there. So it's quite interesting. Now, If we then look at the postcode, we'll start with Devonport 7310. Put that in my model. Okay, Devonport here, 12,600 households. 36% own outright, a third are borrowing, 30% are renting. Not much in the way of mortgage stress, but there is some rental stress in the area. And you can see here that it's mostly houses. People ratios on the higher side there. Interestingly, the vacancy rate was 7%. Gross investment yield is positive, 5%. Net investment yield is positive, 1%. So there you go. There's property investments with a positive return. Average taxable around $73,000 or $62,000 from the census, giving a disposable monthly around $4,400, with 32% going on the mortgage and 27.8% going on the typical rent. And you can see here that price growth, well, maybe in the best case scenario, a little bit of continued growth, but if things go a bit pear-shaped, risk of a fall. Right, let's just look back at the other areas too, and I'll get those other ones sorted out. We have to go to law system 7250. Okay, and this includes a few other areas there as well because it's a postcode level. 22,000 households, 35% owning outright, 34% borrowing, 29% renting, 57% mortgage stress, 66% rental stress, overall financial stress 42, 81% of houses, high people ratio, 7.2% vacancy rate, gross investment yield is 4.7%, net investment yield is positive 0.4%, average taxable 85,000 or 72,000 from the census, giving a disposable monthly income of just over 5,700, with 27% going on the mortgage and 24% going on the typical rent. Scenarios are, I'm struggling to see growth in this area at the moment. And going back to centre of Hobart, which of course will be 7,000. And here, 6,500 households, 30% owning outright, 26% of borrowing, 40% of renting, 44% in mortgage stress, 76% in rental stress, and 61% houses, some units is there as well. Quite high vacancy rates, could be Airbnb and second homes, I suppose, 10.6%, 5.2% gross investment yield, positive 0.7% net investment yield, and average taxable, well, 95,000 plus or minus there, giving a disposable monthly around $6,100, with 32.1% going on the mortgage, 2222, and 28.8%, 1993, going on the typical rent. So that's the story there. Okay. Right. Well, that's caught up with what I was asked to do. Now, I did have one postcode come in right at the start of the show. That was postcode 2325. So let's look at that one. That's Etherlong in the Hunter Valley. So we can put that up. I don't have the price trajectory. I can't do price trends on the fly. I need to run a query to do that. So it takes a bit too long to do it on the live show. But if you come in beforehand, give me the postcode, I can add it in. Okay, so here in this postcode, 11,400 households, 34% owning outright, 37% borrowing, 28% of renting, 56% in mortgage stress, 87% in rental stress, about half of households in financial stress, 80% of houses, and 3.1% gross investment yield, negative 1.3% for the investment yield, net investment yield. Average taxable, 80,000, census said 70,000. Disposable monthly around 5,200, 35.2 going on the typical mortgage, 1836, and 30.6%, 1595 going on the typical rent. Looking at the scenarios ahead, well, best case scenario, a small rise over 3 years, but the base case and worst case, a bit of a fall. Right, so I've caught up now on those before the show. So now it's a good chance for me to have a quick look over on the chat. I saw a couple of requests coming in. It's always difficult when I'm doing my own show here to keep the chat going up to date. So I'm going to go up to the top of the list and see what we had and whether there are other requests coming in. Let's have a look. Hey, Cookie, nice to see you dropping in. Thank you very much. And thanks for all the articles you're sending. Very appreciative of that. He also mentions the Canadian real estate investment funds have stopped investors from putting the money out due to Canadian housing price market collapse. Yep. Could come here. It could happen here. JP Morgan no longer expects a rate cut, predicts hike in 2027. There you go. Okay. Down the list. And Cookie also makes it. Cookie, very prolific here. Central Coast was one of the big growth stories during the lockdowns. Now most outside metro areas hit a wall. Yeah, absolutely. It is very interesting to see. I'm watching the same in Thurul, by the way, as well. Broken Hill is still cheap. Australia Treaty Asia. Interesting. Cookie again. Aussie 10-year bonds. Yes. Well, I still think we're going to see rates higher. I must tell you, it's difficult for me to see unless we get a real problem in terms of unemployment that things are going to actually allow interest rates to be cut further. I'm afraid that the RBA really has not done a great job. They were trying to protect the jobs market, but in so doing, I think they've built a real big problem. Now, we'll see. Could be wrong. Okay. Nola Mara, postcode 6061. I love finding out new places. Well, you always surprise me with places I've never heard of before. Okay, this is including Balgar and Westminster as well. Let's put this on up. Go there. Drop that off so you can see it. Okay, so this is Western Australian postcode in the Wanneroo SA3, Perth Northwest, in the federal city of Cowan. 17,200 households, 18% own outright, 36% are borrowing and 44% are renting. 94% are in mortgage stress, 83% are in rental stress. Households in financial stress, 77.8%. It's mostly houses, 62, but we've got some units of types of property there too. They've got a vacancy rate of 8.4%, got a people ratio of 2.2, so that's going to be some families. Gross investment yield is 3.8, but again, net investment yield is negative, minus 1%. I must say, more and more investors are losing money on a cash flow basis. So if you don't see significant price growth, you've got a problem. Okay, looking at the disposable monthly here, the taxable income was 73,000 or 71,000 based on the census versus the ATO. And looking at the disposable monthly, it's around $5,200 with 34.4 or 1820 going on typical mortgage and 30%, 1594 going on typical rent. Now, I have a bit of a fall in my model here because of this high level of stress. Now, we've seen prices rise quite strongly in Western Australia up to this point, but have they reached a peak? Will they slide? We'll see, I suppose. It's certainly quite an interesting question. Okay, another postcode here. Can I look at 4879? Sure can. This is Palm Cove in the far north. Lovely area. Been there a few times. Mostly in the winter. It's not too hot. 9,000 households, 30% earning outright, 4% of borrowing, 29% of renting. Some mortgage stress, but 35%, and some rental stress at 36%. So not as high as some other areas. 78% of houses in this area. People ratio is 2.1. The vacancy rate was quite high. That's, of course, Airbnb and second homes and things too. Gross investment yield is 4.1. Net investment yield is just positive. Average taxable in the area is 86,000 or 88,000 from the census, giving a disposable monthly around $6,200 with 33.3%, 2,080 going on the typical mortgage and 31.9, 1993 going on the typical rent. And Best case scenario, significant rise is still ahead. Base case, a bit of a slide sideways. Worst case, a bit of a fall, down 21%. Okay, let's go down the list. Alpha here asks for 4304. So this is in the Brisbane and Moreton areas around Silkstone. Got that right? North Bowville. Yes, it's there on the list. Okay. Just take it off so you can see it. Okay, 7,400 households, 25% on that right, a third are borrowing, 41% are renting, 65% in mortgage stress, 97% in rental stress, overall financial stress is 65%, 83.7% houses, 2.23 the people ratio, so families there, I guess, 7.5% of the vacancy rate, gross investment yield's 4, net investment yield is minus 0.4. Average taxable, 73,000 compared with 67,000 for the census. And that translates to a disposal monthly around $5,000 with 31.3% going on the typical mortgage, 1,560, and 30%, 1,495 going on the typical rent. And yeah, small rises ahead on the best case scenario, but the base and the worst case is a potential fall. So we will see. I've done that one. No need to keep putting it in if I see it as I go down the list. Gisborne from Craig, 3437. $4,200 households, 34% earning outright, 50% borrowing, 14.5% renting, 52% in mortgage stress, 81% in rental stress. Overall financial stress, not as high as some other areas. 89% of houses here. The 2.66 says families. 5.4% is the low vacancy rate. Gross investment yield is 3.4, but the net investment yield is negative 0.8%. The multi-flag comes up, suggesting the average taxable, 105, is lower than the household, 120,000, so multiple incomes going on the mortgage, giving a disposal monthly around $8,400 with 30.6%. or $2,600 going on the typical mortgage and 24.7%, $2,098 going on the typical rent. From the scenario perspective, well, difficult to see much growth at the moment. And if things go pear-shaped, then prices could fall quite considerably. Warsome asks for Bulleye. My own back door. Know Bulleye very well. Okay, 2,545 in the area, 34% earning outright, 44% of borrowing, 20% of renting, a third in mortgage stress, well, 30%, 66%, two-thirds in rental stress, and 80% of houses in the area. Vacancy rate is just 4%. The people ratio is quite high, so some families. The gross investment yield is 3.3. Net investment yield, again, is negative 0.7%. Average taxable, 116 compared with 121,000, giving a disposal monthly around 7,000, with 42.7% going on the typical mortgage, just over $3,000, and 26%, 1,843, going on the typical rent. Scenarios, growth over 3 years at 5% or so. Base case, a bit of a fall, 9% over 3 years. Worst case, down 28%. And very nice places in Bulleye. If you've got a bit of a view, it's can be rather nice. Now, Craig West asks for 3060. Have I done that one? I'm not sure. Let's have a look. Faulkner. No, I don't think so. Okay, Faulkner. Let's put that one in. This is in the Tullamarine Broadmeadows area of Melbourne. 5,000 households. 37% earning outright, 31% borrowing, 31% renting. Not much information here about stress, so things are looking pretty good. 83% are in the house category. People ratio is high, so families there. Higher vacancy rate, 3.2% gross investment yield, net investment yield minus 1%. Average taxable around 77,000 or 74,000 here. Disposal monthly 5,600 with 40% going on the mortgage 2251 and 33% going on the rent 1873. I'll highlight the fact that I think in these areas, because the prices of properties are a little lower, it's a little bit easier for people. So this isn't a stressed area. As a result of that, there is still growth in this postcode in my modeling. Best case 16% over 3 years, base case 2% over 3 years, but a fall if things go really badly. Warsaw comes back. Cheers, Martin. What about Bellencombe? 2617. Okay, let's try it, shall we? Okay, this is in the Canberra area. And interesting, of course, the University of Canberra is in this area too. 15,600 households. Get that off so you can see it. 24% owning outright, 34% borrowing, 41% of renting. The stress is 13% mortgage, 73% rental stress, some financial stress there. 49% of houses, 28% of units. 2.25 is the people ratio, so that's some families there. 6.8% vacancy rate. 4.3% gross investment yield, positive by 0.1% net investment yield. Average taxable, 91,000 or 113,000 on the census, giving a multi-flag. Disposal monthly around $7,500 a month. 31.2% or 2,340 going on the mortgage. 29.3, 2,193 going on typical rent. Scenarios, best case, another growth of 2.4% over 3 years. Base case, a fall of 12% over 3 years. Worst case, down 32%. Bradbury. Now, you'll have to give me the postcode because I can't reverse look up Bradbury easily. Can you give me the postcode for Bradbury? I can look it up for you if you do that. And we can probably find it. I might be able to, maybe I can Google it if you can't do that. But if you put the postcode in, I will find it. Okay. So I think I'm up to date with the chat here. Logan says, if you have the funds, you can buy almost anywhere. Yeah, of course. Yes, if you have the funds. But the trouble is, of course, a lot of people don't have the funds and have to borrow. And that's where you get into this issue. And the point I want to make, as I tried to make at the beginning of the show, for a lot of people, it's not an issue. You know, they're still seeing incomes growing. They've got significant assets. They've got significant wealth generation, and they're fine. But it's the others that I'm concerned about. It's the people who are actually caught in this trap, perhaps in the rental sector, and trying to think, well, if I move in to buy a property, can I get away with spending less or spending the same but owning something? And of course, people are looking further out because price rises have actually been quite extreme. And then they get into this bit of a doom loop. Used to be the case. The people would commit to the gills, but over 3 to 5 years, income growth would be significantly stronger than the mortgage payments, and they'd get out of jail. It's not happening now. There's no real income growth for many people since, well, 2005, 2008, 2010, you know, for a lot of people. Costs of mortgages going up, costs of rent going up. And the pressure on households in real terms is the issue that I'm seeing in my surveys here. So, aha, somebody came in there with, oops, 2560. Okay, let's see whether 2560 works. Thank you for that. Yes. Bradbury. Yes, we're there. Okay, let me put this back on the screen. Thank you for the Google. Appreciate it. I love it when it works. Okay, 30,000 households here. 23% owning outright, 39% of borrowing, 36% of renting. The numbers look pretty sick in terms of mortgage and rental stress in this area at the moment. A lot of financial stress there as well. 78% of houses. People ratio is 2.64, so that's going to be families. Not huge amounts of vacancy there. 3.3% is the gross investment yield. Net investment yield is minus 1.4%. Taxable, 78,000 for income. Census said 83,000. That gives a disposal monthly around 5,600 with 42.3% or 2,400 going on the mortgage and 33.4%, 1,894 going on the typical rent. And from a scenario perspective, I ain't seeing much growth according to my modeling. So we will see. Interesting question coming in here. Thank you for the question. How do you project growth forward? Well, the model takes three things into account. It takes the price history trajectory and says, what does that tell us about the future? It takes the affordability question into account through the stress calculation, and that adjusts it. And then it has an economic overlay based on the overall other economic indicators like the CPI and interest rates and those things. So that's how it's a bit of a complex model. All those three factors feed in together. Okay, 3336. Let's see whether we're lucky this time. I can't always guarantee every postcode, particularly small pops. Yeah. 3336 I have. So there you go. Let's put the slide on. So this is Melton, and 5,000 households, 24%, 75% of borrowing. So a lot of people with mortgages, a lot of people with mortgage stress in the area, mostly houses. It's 3.29, and vacancy rate was 2.8%, so quite low. This is probably one of those new growth suburbs. I'm guessing, I don't know, but I'm guessing. Gross investment yields 2.9, net investment yields negative 1.1%. Average taxable 81,000. The census said 119,000 for the household. Again, the multi-flag comes up. This is where multiple incomes go to pay the mortgage. Disposal monthly around $8,000. 32.3% at $2,580 a month going on the mortgage, and 26.3%, just over $2,000 going on typical rent. And scenarios are growth, positive growth. Best case scenario, 10% over 3 years. Best case, a bit of a fall. Worst case, a more significant fall. Cheers, Vanessa. Thank you very much for dropping in, and appreciate your presence on the stream as always. And as Jason says, good night. We'll see you next time. Very good. Yep. Well, it is getting on that time, 9:26. We are pretty much at the end of the show here. So I guess let me just round out my conversation and comments here today. The point I'm trying to make here is that we've got this diversification between households who are doing quite well and everything's fine, and those who are not. And it's those who I'm not that I'm most worried about. I don't believe that our policymakers are fully understanding the implications of what's been going on, because the fact is that many people have been digging a hole for themselves over quite a long period of time, and that hole is frankly getting worse and worse and worse. And the question is it possible that it can improve from here? And my sense is that for many people, it's not going to improve based on economic inputs. It's not going to improve from interest rate improvements. It might improve a bit if the banks extend and pretend even more, extend the term of the mortgage, of course, means you pay more interest over the life of the mortgage, or go interest only. But of course, there are traps there as well. And I also am finding in my one-to-one conversations quite a few people who are actually going into refinancing agreements without fully understanding the implications of that refinancing agreement. So I always say to people, if you think you've got cash flow pressures, one, do a bit of an audit on yourself. Look at the money coming in, the money going out. Where's it coming in? Where's it going out? What are you spending it on? Have you got enough to cover all your obligations? If not, how do you prioritize? And the trap here is that people then reach for more debt. And that debt map that I showed earlier on highlights to me that in some cases, there are people with significant stress issues that are just piling on more debt, more credit cards, buy now, pay later, et cetera, or consumer credit. Now, that doesn't help. So it's important to note down the interest rates you're paying on debt. And of course, if you really want to start dealing with this, build a cash flow, look at the money coming in, look at the money going out, prioritize, put some of those credit cards in an envelope, put them away, don't use them again, and then, begin to manage your debt down. Look at the high interest rate stuff first. Now, those are all simple guideline points. For many people, it's really quite complicated. So I always recommend that if you are in financial pressure, and there are a lot of people who are, I see it in my surveys, then call on the experts. And the experts here are actually, it's the National Desk Helpline, 1-800-007-007. This is a government-backed financial counselling service. Very busy, of course. A lot of people are finding it difficult, particularly after Christmas with the credit card debts coming up. And I do recommend them. They are one of the best sources of help, much better than Googling and finding another entity on the place that could charge you for advice. These provide information very effectively. So 1-800-007-007. And they do report that if you get financial counselling, you can avoid legal action, you can get a more positive attitude to your future, you can resolve your financial difficulties, you can improve your mental well-being, avoid bankruptcy, and improve physical health. And that's the point. The point I want to make is that your financial status isn't an isolated issue for you. It wraps into how you're dealing with your family situation and your health and all those things too. So this is a critical issue to get right. And it's a good New Year resolution, right? Get your finances under control. Understand. Only half of households in my surveys understand their finances. The other half just muddle through. Also, by the way, AFCA has this wonderful tool. It's called the Statement of Position. You can go and download it from their website. And if you want to get a summary of how you're faring, this is a really good way of doing it. You can put in your income, expenses, your property, other assets, the debts. And also, if you do have a debt problem, your proposal, that's a really good tool to take to your lender if you want to go down. Remember, the lenders have an obligation. If you've got a mortgage to help, then it's a way of having a good conversation. So that's a really useful tool, and I recommend that. So the AFCA Statement of Financial Position tool. Well, we're pretty much at the end of the show. Jason, I just want to say thank you very much for the super chat. Really appreciate it. Thank you, as always. Really helps to cover the costs. Thank you very much indeed. And as I come to the end of the show, I will just remind you that if you want to get a single snapshot, and you didn't do it on the show tonight, you can contact me via the blog and send me a request via the blog. There's a little chat feature there. Put the postcode in there, and I'll send it to you in the next couple of days via email. Just one postcode. I can't do a whole bunch, but one postcode. If, on the other hand, you want to get the more granular information for all the postcodes we do, we have more than 2,000 postcodes, and look at that same sheet for all those, it's really powerful if you're, for example, making a decision about where might investment properties return or not return over time, or where prices might go up or not. That's available. You can access it via our Patreon program. And that Patreon program, thank you for all those who have supported that Patreon, by the way. There are a number of people at various membership levels. Please go across to Patreon if you'd like to support us via there. But if you want to get the data, $50 per month plus GST is what the program is. And you can subscribe to get that once, or you can continue to subscribe for as many months as you're subscribed. I send that information out. I'm sending it out in the next couple of days for all those on my Patreon program at the $50 level or equivalent Aussie dollar level. And that gives you all the information down to the postcode level, and you can compare and contrast. And also, I'd make the point that if you want to know more about Walk the World, go to thewalktheworld.com.au, which gives you a lot more information about us and what we do, and also our tie-up with Nucleus Wealth and Damon. We had Damon on last week. And my blog, of course, contains a lot of information. If for any reason Twitter goes down or anything like that, my blog is there. Its own URL, digifinancial.com/blog, and you can get all the data there, all the links to all the shows. And if you'd like to support us another way, we do take support via PayPal. Thank you for those who support via PayPal, or indeed even via Bitcoin, if you actually would like to support us that way as well. I don't do this for profit. I do this because I think there's a really important conversation to have. And the point of the matter is we're at the pointy end of things now. So for many households, the decisions they take over the next few weeks will potentially determine their financial outcome ahead. Will they sell their property? Will they refinance? Can they hunker down sufficiently? Or are you at the other end of the spectrum, those doing very well and frankly don't see what the fuss is about? Unfortunately, a lot of politicians are in that camp, but there again, politicians have more investment properties than average. So, hey, there you go. Right. Well, I think that's it. Thank you very much for spending some time with us this evening. Last few comments there. Jason says, policymakers don't seem to care because they have many negatively geared properties. Perhaps they want the turmoil. Yeah, well, maybe. It may well be. They'll hoover them up. And yeah, in terms of the DTI changes, I don't think it's going to have a major impact because the speed limit is very high relative to what most people are at the moment. At the margin, it might impact the investment property sector a little bit. I think the trajectory of interest rates is a much bigger impact, and the latest data on price movements suggests it's already beginning to take an impact on us. So that's my view. And as Jason says, appreciate the views, like banter, and please like, subscribe. It really makes a huge difference to me. I will be back next week with another show, and that show will be looking at property from a rather different angle. So I'll leave it a little bit hanging because there's some interesting stuff we're going to share then. But check that back, or indeed check out our recorded shows. We put shows up on every single day of the week. Haven't missed a day for, well, as many years as I can remember since I relocated. And so I'll look forward to seeing you on those recorded shows or on the live show next week. Thank you very much for spending time with us. Just before I go, doggies are here. They hardly reacted when the postman came, which is fantastic. So it's now time for lunch and another doggy walk. Take care, keep well, and remind you again that financial pressure is something that can be addressed, but you have to get the data to be able to do it and make sometimes some hard decisions. So unfortunately, I think some hard decisions ahead for many, but thank you very much for watching. We'll see you next time. This is Martin Orr from Digital Finance Analytics signing off. Cheerio.